All right. Good afternoon from London, everybody. Good morning if you're in the US. Good evening if you're in Asia. Welcome to this joint session between Vortexa and Eurasia Group. My name is Henning Bloestein of Eurasia Group, and I'm joined by Pamela Munger and David Bech from Vortexa. We will be discussing the impact of Western oil sanctions on Russian crude oil and refined product supply, with a bit of a special focus on the more recent events in the refined products. What is the geopolitical background? What are the real market implications? Where is this oil flowing? And what are the impacts on markets? And what's the outlook for the rest of this year? So I do look forward to the session. If you do have any questions, we have a chat function. Just type it in there. We will try and answer everything you throw at us in due course. Right. I will start off with a little bit of geopolitical context before we can go into the nitty-gritty, and then I'll pass over to my dear colleagues from Vortexa. We all know, we're coming up to 1 year since the start of the Russian invasion of Ukraine. Now, this conflict has unfortunately only escalated since its start almost a year ago, and this is important in this context. At the start of this war, there was many expectations of the Ukrainian government collapsing really soon, and the Russian government could install some sort of puppet regime in Ukraine and shock all the world into a new reality. That didn't happen. European support held high. The US re-emerged almost as a leader of the world in keeping the West together. And in response to Russia's invasion and more increasing aggression on the ground, and the Western response has become ever more stricter. And the tightening sanctions in regards to the oil sector were, of course, last year we already saw that the Europeans phased out virtually all shipped crude oil imports from Russia. The G7 led group of countries put in a price cap on Russian crude oil supply. It kind of passed and went, and the world went on. But since February 5th, we have a new run of sanctions and Western measures. The first one is Europeans have now officially stopped importing seaborne refined products shipments from Russia, and the G7 have introduced a price cap by the insurance mechanism on Russian seaborne refined product flows. So the big question is, of course, first of all, how is this conflict going to develop? Is there a chance that sanctions go away? I'll very briefly say something about that and then hand over. Our view at Eurasia Group is that this conflict is not going to go away anytime soon. Even if there was some form of a ceasefire, which we don't expect at this stage, for the simple reason at this stage, both sides still think they can win this conflict. And when both sides think they can win the conflict, there are no peace negotiations. The other reason being that the maximum compromise either side is willing to accept is nowhere near what the other side is demanding. So there's no overlapping compromise possible at this stage. Both sides, they think they're going to win, and that is why we don't expect anything. But even if it did happen, and there was some form of surprise ceasefire, we do not think that would immediately result in a relaxation of Western sanctions and measures. This would require a much longer process of rapprochement, of trying to see whether the ceasefire stays in place without breaking apart, which we think that there would be a high risk of. So at this stage, Eurasia Group thinks that the oil sanctions that Western aligned nations have placed on Russia are going to be in place for quite a long time, so that the global oil world has to settle into this new reality and deal with it. So with that, I am going to hand over to my dear colleagues from Vortexa, Dave and Pamela. So what is the new reality? How is Russia dealing with this? Where are things flowing?
Thank you. So we start with the crude oil perspective. You can see on the left-hand chart here that exports of Russian crude oil, this is excluding CPC blend and KEPCO, which are Kazakh grades. You can see that exports are actually doing pretty well in January and the early days, first week of February. We are at a level which is one of the highest over the last couple of years, the last 2 years, and it's not far off to the pre-COVID times. So on the export side, basically the sanction regime has been type of successful to keep the Russian oil in the market. That's one of the reasons why oil prices have been below $90 for the last 3 months or so. If we look at where the oil is actually flowing to, we can see that there the picture is not looking as good, basically. So we had these last 2 months here significantly lower arrivals of Russian oil. That's the one thing we can see. First week of February again looks good, but 1 week is always, how to say, can be pretty choppy. The key aspect here on the crude oil side is that essentially you can say there are only 2 countries left in the world that are buying Russian crude, and that is China and India. You can see basically equal shares now. China has picked up quite massively over the last 2 months. They have been pretty hesitant, especially in December and into January, in taking Russian crude. That's especially the case for the state-owned companies. The private companies in China are more interested in those barrels. So that's raising basically a couple of questions on the future. It's clear that China and India are in an extremely strong negotiation position versus Russia. They can ask for substantial discounts. We will talk about logistics later, but basically, due to the high logistical costs involved, the money Russia gets for their oil currently is really pretty low. It's usually below $50 per barrel, at least if we talk about the European side flows. The Asian ones are looking different. Now, as said, we're talking about logistical hurdles afterwards. But what we can see on this right-hand chart here right away is that the amount of Russian oil on the water, and that's chart is showing crude, residues, and light products, clean products, that has basically doubled. So by now, right-hand axis, we have 11% of any oil at sea globally is of Russian origin. And that is, on the one hand, a reflection of the much longer travel times we have now to the long-haul distances, destinations like China and India. But it may also be a bit of a reflection that Russia, at least at the margin, may be struggling to find the final buyers. Now, I have said before, there are only 2 countries really buying Russian oil. What is very interesting is that Turkey has actually cut back. I mean, first of all, let's start with after the war started. Last year, you can see Turkey has been opportunistically buying a lot of Russian oil, partly as high as 400,000 barrels per day crude oil. But with the European sanctions coming into force, they have cut back the crude imports quite significantly. And in January, only one of the 3 main refineries was actually taking still Russian crude. So it's interesting that Turkey is, how to say, type of complying with European sanctions here, and that's leaving this massive exposure of Russia to China and India. And with that, I pass back to you, Henning, asking, are China and India at risk here politically, being so opportunistic?
Thank you, David. Yeah, very briefly on the Turkey side, indeed, a lot of people expected Turkey to buy more Russian oil because it's, the Black Sea, Urals crude could go there really easily. Turkey is under immense pressure by NATO not to be seen too openly profiteering from the situation. This is probably why they're holding back. China and India are different beasts here. We do not think that India at this stage is under heavy pressure or had a high risk of secondary sanctions, which maybe the United States would be inclined to impose. For fairly obvious reasons. The Indians have made really clear to the Europeans and the Americans that they see this as a European conflict. They sympathize, they do not condone Russia's invasion, but they see that this is a European conflict, and India kind of sees itself as the new rising neutral power. It's neither Western, certainly not pro-Chinese either, but it is a rising neutral power and democracy, and they do not want to be scarred or involved by this conflict. And they have said that if they have implied heavily that if they were to be slapped on by secondary sanctions because of this war that they see essentially as European, that they would derail all sorts of Indo-Pacific partnerships with the West and especially the United States, which Washington really doesn't want to happen right now. So we do not think they're at high risk. So they will be able to continue to opportunistically buy Russian crude oil and maybe refined products. China is a slightly different situation. China, in fact, actually, as your chart already showed as well, imports of seaborne Russian oil haven't gone up as much as India's has. We think there's two reasons here. First of all, a lot of the Chinese state-owned oil companies actually trade out of Singapore, and Singapore has imposed sanctions on Russia. So this makes it a bit awkward. That leaves the private refiners in China who operate out of mainland China, who I'm sure opportunistically have been buying this. But I do not think at this stage the US has an interest in escalating the sanctions conflict with China. The relationships are sour enough as they are. And so I do not think there is a big risk of secondary sanctions on entire states or like state-owned majors in China or India. There's a little bit of a different risk when it comes to ship-to-ship transfers, but I'm sure we'll talk about this a little bit later. And that would be towards individual shippers and companies maybe. But on a large scale, we don't expect a big sanctions conflict between the West and India or the West and China at this stage. I'll hand back to you.
Yeah, great. Now, as opposed to, crude, looking for alternative markets for crude, and as you just mentioned, those mainly being India and China, it's kind of the opposite for diesel. Russian diesel has many markets, but first let's look at the chart on the left-hand side, and you can see in the latter part of 2022, Russia increased quite rapidly its diesel exports, its total diesel exports. This is by port, and you can see it as a multi-year high. It's come off a little bit in January, and some of these large volumes can be explained because of seasonal patterns. You notice every sort of Q4 they increase in exports, but it's also to say that Russia was refining, its refining capacity ramped up, and also it was really making a big push to push these exports over to Europe before that February ban. But this just shows the extent of the Russian diesel exports that are out there. Now, if you look over to the right-hand side, this is imports of Russian diesel by selected markets. And you can see how this January bar here has fallen. It's quite low, as opposed to the previous month's bars pretty much reflect what we noticed in exports. Well, this drop in bar here, in comparison to the January bar on the left-hand side chart, is a reflection of those markets that Russian diesel is moving to that are far further away than core Europe. So you can see the unfriendly markets rarely represents those core European countries. This red line here is dropping rapidly post February 5th ban on the Russian clean product imports, and meanwhile you see these non-traditional markets increase. So you're really looking at large volumes going to Turkey. We've seen a large volume going over to Morocco. Certainly. We think that these more non-traditional markets, Brazil as well, further afield, further away. However, just one more point, but that the point is that there are many markets in order to place diesel, probably more so than crude.
Thank you. I can directly sort of throw a question at you here. So, okay, there's the sanctions. The Europeans can't buy diesel, any refined products from Russia now. And I'm aware that the tightest market is the middle distillates market for diesel and heating oil probably as well. Now that the Europeans can't buy that from Russia, they're probably going to buy it from somewhere else. Like, first of all, where are they going to get it from? And is there enough? And is there also enough for emerging markets? Because we saw in other markets last year when the Europeans had to replace all that Russian natural gas, they hoovered the global LNG market dry, and it really priced out some emerging markets. Is that a risk that you see here, that emerging markets actually the ones that lose out of on this, not the Europeans, or is there enough in the market to supply everybody?
Yeah, I mean, I think that as we can see here, let's just start with this chart here, and you can certainly see this is diesel and gas oil imports by the European countries, Norway, Switzerland, and the UK. And you can see that that if you look in January, that this bar is not too far down from previous months' imports. into the European Union. And meanwhile, the percentage share from Russia has tanked, quite frankly. And so what does this mean? This means that you can see more coming from, or large volumes coming from intra-European. So European refineries have certainly been running really hard, and this has been helped by a decrease in natural gas prices to help run those secondary units. Also, as well, we've seen large volumes coming in from Saudi Arabia, from India, and then China, of course, had a big push late last year into January as well. And keep in mind, this is really before, there's a large volume, 1.7 million barrels per day, I think, of new refining capacity that's expected to come online in 2023. This is well before that's already occurring.
Yeah, I would like to add here perhaps that if we look at the volumes over the last 3-4 months, basically, you can see that the imports into Europe have been way higher than they usually would be. So basically what has happened is that Europe continued to buy the Russian diesel at a rate of about 600,000 barrels per day, and at the same time bought already replacement barrels. And that allowed tanks to be, or stocks to be built. That basically means that from here onwards, in all likelihood, Europe will buy significantly lower volumes again, because basically we are behind the winter. The winter is not as problematic as we thought. Natural gas situation is good. We have clear signs that the recessionary environment is starting to hit consumption. So basically the European diesel demand is definitely not up here. It's much more likely to be somewhere down here as last year. So that means Europe is probably well off if it continues to import at the rate from non-Russian countries as it did in the last couple of months. And at the same time, these Russian barrels will only, as of now, start to really hit the alternative markets on a higher rate. So this factor is basically one of the key reasons why diesel prices, or relative diesel prices, diesel cracks have really tanked over the last couple of weeks. Yeah? So there is evidently at this point of time enough supply in the market. One way to make this point is, if you look at global diesel imports in January, so an entire world, not on this chart here, they have been up year on year by 1.7 million barrels per day. So refiners and traders have made a huge effort and have providing so much more diesel to the market that this 600,000 barrels per day shift is really looking relatively tiny. The problem from here onwards really doesn't look to be any more diesel. It is the question whether the refining system overall is powerful enough to supply the market. But at this point of time, there are not too many questions mark about this. As Pam mentioned, new capacity is coming into the market. At the same time, demand is not looking particularly strong. And just a quick note here as well. Of course, there may be quite some upside from demand in China, but that will not have a net effect on the rest of the world on the product side, because Chinese demand is always met by internal refining capacity. It may have an impact on the crude market, but not on the product market.
Thank you. That actually brings us to the situation. We at Eurasia Group, we talk a lot about, and we don't track ships in detail like you do, but it seems more like the overall situation that this has caused in crude, but also now seemingly in refined products, is one of a dislocation rather than a disruption. So by dislocation, we mean that that the sanctions regimes and the tightening effect this is having isn't disrupting the overall volume of crude or refined products, but it is pushing products into areas that under normal circumstances wouldn't be economically feasible, but is now happening. And that is a premium that the market is paying for because it costs more money than usual. Is that something that you would agree to, David and Pamela, or are we sort of offbeat here?
Yes, that's basically what is happening. And if we look, for example, here on the right-hand chart on the crude supply situation, so we're seeing here crude imports into the EU countries again, and we're doing this versus the 2019 average. The red line shows you the total, so you can see here the big decline versus 2019 in the COVID period, and last year a significant comeback. And actually the last 2 months in this chart, December and January, we see more imports now into Europe than before the COVID period. You can see here where this is coming from. So it's coming from North America, It's to a certain extent coming from Africa. It's coming from Europe. Basically, European crude, that includes Azeri crude in this chart, is staying more in the region than moving out. That includes also the Johan Sverdrup grade from Norway, for example. Who else do we have? Latin America is a relative significant contributor here. So basically, the point here is that Europe specifically is in a very good supply situation. There is a lot of suppliers in the relative near vicinity. This is not necessarily long-haul supplies. So it's just a bit of a reallocation in the market. Of course, the Russian barrels that have been lost, and you see here the massive decline here, they have really to travel relative long distances. So there are certain additional logistical costs, but relatively speaking, these logistical costs are small compared to the outright price. And the real question is simply, are the supplies available overall? And that's what we're seeing currently, both in terms of crude and product. Russian supplies continue to flow to the market. They flow to a different location, but they continue to flow, and that's the important part. Talking about the crude supply sources to Europe. If we look at the Middle East in the light blue bars, we can see Middle East has lost market share in Europe in the COVID period as other players. They have basically come back to break even, which brings me a little bit to the question, how does actually OPEC cope with this somewhat challenging environment at this point of time? Russia is a key partner in the OPEC Plus situation. Can you shed some light on this question?
Yeah, thanks. This is one of the most important questions, I think, geopolitically in this space, because OPEC Plus, as it's become known, is an unnatural alliance. So it's easy to forget that only 3 years ago, OPEC and Russia were not working together at all. In fact, right at the start of the pandemic, when everyone was literally going into lockdown, OPEC and Russia engaged, especially Saudi Arabia and Russia, in a very brief war of supply, raising supply just as everyone had to lock themselves in, and that was when WTI famously went negative. So this is not a natural alliance. Now, with on top of that, the conflict in Ukraine, this makes it even more awkward. Does Saudi Arabia and OPEC as a whole can support global oil markets, the Western urge to keep prices under control by raising supply, but thereby threatening its shaky alliance or unofficial alliance with Russia? Or does it hold back with its supply situation to wait and see? Now, when OPEC late last year said that they would cut back output, they got a lot of criticism, especially from the US, but also from Europe and even in Northeast Asia a little bit, for cutting supply when prices were, close to $100 per barrel. That this, it really soured the relationship between OPEC and especially Saudi Arabia and the United States even further. The issue is, though, this is, I think, a bit of a defense argument, that the OPEC's point of view is like, you can't raise output into a situation where at this time everyone was expecting Europe to go into recession, the US to go into recession, and China was still in total lockdown, and there was virtually, there was no normal oil consumption there. You can't just raise supply into that situation and then risk crashing the price again. So from that point of view, it's quite understandable just to wait and see. And of course, if now we're a few months later, it's kind of played out in the way that OPEC would have liked to have paid it to play out. That said, the relationship between OPEC and Russia remains very complicated. And I think OPEC is in a very complicated position here because it is facing pressure from the West, and particularly the United States, to not let oil prices spiral out of control, to supply more oil when there is demand. At the same time, the Riyadh in particular doesn't want to threaten this relationship with Russia at this stage. I don't envy Saudi Arabia and OPEC in their position, but dare I say, so far, I think they have managed it actually fairly well against the fact that virtually every side is criticizing them for whatever reason. And I think they will try and continue doing that. It's not going to be easy, but I think that's what they're going to try doing. You could see that Mohammed bin Salman met US President Joe Biden, although they really don't like each other. The Saudis continue to communicate very closely with their allies in Japan, in East Asia, and they also continue to communicate with China and the European Union. So I expect that part actually to continue as it is. fairly quiet and fairly steady. I have a quick question for you too. When we see now the the disruption of of global oil markets, what is the difference in terms of logistical challenges between crude oil and refined products here? Because we know crude oil tankers can be really big, VLCCs, very large crude carriers. They're dirty, you can just chuck crude oil into it, whereas refined product tankers are cleaner, you have to scrub them if you want to switch products. What's sort of, from a logistic point of view, if you're a shipper, what's more easy to handle, the crude oil side or the refined product side?
Yeah, that's a good question. I think, let's say, technically, they're probably similarly to handle. I think one crucial difference is that there are all the spotlights on any single crude tanker right now. Yeah, the amount of media requests we got over the last couple of weeks on basically the question specifically of the ship-to-ship transfers happening offshore Ceuta in Spain and offshore Kalamata in Greece. It's tremendous. I have really the feeling every single journalist out there is currently tracking the Russian oil on VLCCs and on the other tankers. So I think this is a crucial part, and this very high level of interest and also to quite some extent transparency is one of the key reasons that is keeping the very most countries in this world from buying Russian crude. And I think that's simply different with diesel. It's simply smaller vessels. As Pam pointed out, there are way more players out there that do need diesel than players that do need crude. The public scrutiny will be smaller. So Pam pointed out that that Turkey is actually a key import of Russian diesel, and at least in early February that continued to be the case. So we may have a situation where Turkey is staying away from Russian crude, but buying Russian diesel. Yeah, and that would be reflective of these different levels of scrutiny and interest in the market. Purely from a logistical point, to talk a little bit more about the details, what we see on this right-hand chart is the amount of Russian euros that is transferred via ship-to-ship transfer. In the bars, we see those volumes and we see where it happened. Historically, we have other STS locations. Very often it happened in the area, in the Danish Straits, basically. So the point is, the problem Russia faces is it has now to export all its European crude to China and India, so very long distance markets. But the ports are all located in areas where they can only load Aframax and Suezmax tankers, no VLCCs. Yeah, in the Baltic, in the Black Sea in particular, and I think it's ultimately also the case for the Arctic waters. So what is basically very difficult is to use exclusively Aframaxes and Suezmaxes to send the oil all the way to China, because it can take, or it will take, about 4 months until we can load the next cargo. So what is happening is that these Aframaxes and Suezmaxes are going to the Mediterranean, and they are basically loaded there onto VLCCs, passed onto VLCCs. We have a map that illustrates a couple of those cases. So these are 1, 2, 3 VLCCs currently on the water. They have done ship-to-ship transfers in this area. This is a VLCC that has already done 2 loads in the Kalamata area. And via this, basically, you can push the burden, so to say, the capacity burden from these Aframax and Suez class vessels to the much bigger VLCCs. And in the VLCC segment, there is no shortage of capacity and won't be. What we have seen both on the crude and the product side is that a lot of vessels have been sold on over the last couple of months, over the last year. So there is a lot of new players. It's very intransparent players. So it's a mix of Russian interests, partly located in the Middle East, some other trading bodies in the Middle East, but also Indian companies and Chinese companies play a relative big part in here. And the point is ultimately, it's difficult to get details on what is the price paid by the refiners in India and China. but there is about a $30 or so gap, up to $30 per barrel gap. So there is a lot of money to be made on the logistical side. Yeah? And who exactly makes that money? It's partly a little bit more difficult to say. Some of that may also flow to Russian, maybe income for the Russian side, not necessarily in Russia, difficult to tell here, but anyway. Let me try to come back to track here. I think that's the main thing I wanted to say on the crude side. So I'm passing on to Pam now to get some ideas how the system may work on the clean product side from here onwards.
Yeah, thanks, David. So as you mentioned, I think from the crude side, larger vessels, a bit easier to track, a lot of public interest, as opposed to diesel cargoes moved on smaller vessels. It's a very large market. Oftentimes they're headed to ports, and we'll get to the STS side in a minute, where possibly they could be doing STS, but it would be hard to track, because if there's a refinery there, you're not entirely sure if it's refined product from that refinery or where the origin comes. It becomes mixed very quickly. Just one representation of this is quite interesting, though, from a change in flow perspective, are the Moroccan diesel imports, which you can see here over time. You can certainly see this large bar here, this yellow bar is coming from Russia. Now, Morocco used to receive, I think, what this kind of accounts for 60% of its diesel from Saudi Arabia, and now it's starting to receive these volumes from Russia, backing out those Saudi volumes and backing out those Spanish volumes as well. So most likely what's going to happen, those Saudi barrels that used to go to Morocco are then going to land in Europe. And then obviously the same with the Spanish diesel volumes as well. So you can definitely see this reshuffling happening. Europe is already receiving large volumes, as shown on the previous slide, from Saudi Arabia. So that's something that perhaps vessels can do is on the backhaul after coming from Middle East and India, carrying diesel to Europe, then possibly go load Russia, take diesel over to East Africa, North Africa as well. So that's certainly an option. Now, looking at the
perhaps if you allow me to come in here, I think the an important part of the points Pam was just making is that this doesn't necessarily mean a lot of additional ton miles or vessel demand. So to specify it here, if the Russian vessel goes now to Morocco instead of Italy, and the Saudi vessel goes to Italy instead of Morocco, there is not really a difference in the ton mileage. And if we take the other example Pam raised, if a big vessel, perhaps in the future, bigger vessels than the past, LR vessels, loads in the Baltic, goes to somewhere East Africa or the wider Arabian Sea, perhaps unloading via STSs, and then loads an Indian diesel cargo and brings that to the Mediterranean or to the Northwest European market, perhaps again unloading via STSs. That is actually adding ton mileage, but it's not adding vessel demand, because the vessel is basically loaded on both legs. Yeah. So from that point of view, there are very well options to supply the market, also partly, how to say, dislocated market, without a massive additional call on the fleet.
Yep, thanks. Just to bounce to the right-hand side chart, which is just really showing the imports, and this is interesting, imports of naphtha via STS transfers, as we mentioned, to the destination country. And so naphtha is Russia's second biggest clean product export after diesel. Mainly flows to ARA in the last couple of years, because naphtha cracks have been so poor, petchem demand very low in Asia. However, so obviously it can't find a home in ARA any further, and now we're seeing it flow to kind of Singapore in larger volumes here. Singapore, South Korea, and Taiwan, and this is interesting because of what you mentioned. I think previously, Henning, is that there are currently sanctions in that area. So that will be interesting to see what that looks like going forward.
Yeah, that was an interesting one. Singapore, it's a greater water area there. which then not always clear where things go and what comes out on the other end. The sanctions are for trading, so financial trade dealing activity, and the Greater Singapore port area is not directly impacted in that sense. And yeah, I mean, there's always there are those usual ship-to-ship shipment hubs, STS hubs, Greater Singapore, which includes Malaysian waters as well. We've also got, I guess, Fujairah. We saw on the earlier map the Mediterranean, some STS activity. We know that the European Union authorities are extremely worried about that. So I mean, I don't have particular insight into what will happen, but we know that the authorities are worried about it. We know that virtually all the EU authorities are also NATO. I'm pretty certain there will be pressure to clamp down on STS activity, like, as we saw there, parts in the proximity of Spain, eastern Mediterranean days, Greek Cypriot waters. I think that there will be efforts to not have that go there right in front of the EU nose, but that doesn't mean that it won't happen, because David, you mentioned ship markets are intransparent. I think that's a very nice way of putting it. They're one of the most opaque markets in the world, and you can do STS transfer. You can see the off coast Madagascar, west coast of Africa. There's been in the past, I mentioned Fujairah, the Maldives. So lots of places you can do this, and this will be very hard to police or to track. I mean, sanctions busting is an old game activity. This is not the first time. It would be very, very difficult to fully. But that's why we see all these headlines of ghost ships.
The problem with any locations over here is that it takes away most of the freight advantage, of the logistical advantage, because then the Russian Aframax would still have to go all the way to these places. But it may be ultimately necessary. In this context, it's interesting that most of these vessels we're listing here, they have actually been active in the first round of STS's last summer period, and that happened somewhere here in the North Atlantic off the Azores. So that was not perfectly clear whether it was in international waters or still in the Azores waters, but anyway, it was in areas where it's probably more difficult to track and less likely to be followed up by authorities. As a final comment, perhaps quickly to follow up on this logistical challenges. So what we see also the question whether there will be any issue with vessel supply. On the clean side, we think this is extremely unlikely. So first of all, as said before, there has been a lot of activity in terms of sales. So we have here some estimates put together where we see the different clean tanker classes, Handysize, MR and LRs. The Russian interest is relatively small here, but we have seen a lot of sales and purchases in those segments over the last year, and most of that has been done with the preparation probably for carrying the Russian products. You can see that most of those tankers are more than 15 years old, so this is this classical fleet that is handling the sanctioned or semi-sanctioned barrels. It's also very important to make a point here. There is nothing illegal about a non-EU, non-G7 country buying Russian diesel without making use of European services. So this is perfectly legal. It will also be legal on the crude side, but evidently people are staying away from it. But on the product side, I think this is less likely that people will stay away from it. And the second thing is, as I already pointed out in the Q&A section, of course, there is a price cap mechanism in place. And we think it is also more likely that European services, shipping companies, insurance and so on will stay involved on the clean product side than they may be involved on the crude side. So here again, there may be this differentiation, and with the current price level, there is actually the potential need for Russian discounts is actually not that big, purely from the price cap perspective. It will be more the question from how big the market is for the diesel. But the one point I want to make here as well is that Russia evidently needs any income it can get, and the income it can get from diesel is so much higher than the income it can get from crude. Yeah, so even with the crashed diesel cracks and the relatively lower outlet prices, they can earn at this point of time about twice as much money on a diesel export than on a crude export. And from that point of view, it is very likely that Russia will continue its diesel exports, pretty much at every cost. Yeah, and if that cost is basically the application of the price cap mechanism, I think they will somehow accept that, not see it, not document it internally, so that this remains a possibility. So we don't really see an issue with vessel supply, even less so ultimately on the clean side. In the worst case, as a final comment, you could also clean up coated Aframax tankers and make use of them. That will not be necessary, but there is simply a lot of ways how you can cope with this challenge on the clean tanker side. And what should be said here perhaps as well is, if we look at the market rates for all these vessel classes, dirty and clean, they have collapsed over the last couple of months. So the standard market is actually pretty cheap again. It's in this semi-sanctions or sanctioned environment where the freight costs are still high, but not in the rest of the market. So as a quick comment to the bigger picture here, this low freight rates across the board, the range-bound crude prices, the collapsing type of diesel cracks, all these factors are simply telling us as well that oil demand at this point of time can't be particularly strong. Yeah, so we clearly have from this also some indications that the recession is biting, and as we talked about OPEC before, I think there was such a big outcry when OPEC cut their export targets in November. But I think in hindsight, it's fair and to say that they were actually perfectly right to doing so. They have been proven right by the market.
Thank you. There's actually a fair few questions in there. So before we get to those, this leads to a big question, sort of, because as Pamela and David, you've been saying, is that like this looks relatively benign. So like, the worst fear scenarios that, there'd be diesel shortages and before that crude shortages and don't seem to be happening. There's an interesting aspect to this as well. It's like, does that also imply that the sanctions aren't working? Now, if you talk to people who are close to the sanctions space and implementing and planning them, it's an interesting aspect, because what they've come around to over the last half year or so for the oil sector is they do not want to disrupt crude oil flows or refined product flows. They don't want emerging markets to run out of fuel, because that would play into the hand of Moscow saying, here, look, it's those Western sanctions that are causing economic harm to you. They also don't want, in a time of already high inflation, Brent to go to $150. This is all stuff they want to avoid. So what this aim of the sanctions at this stage is to actually reduce the revenue for Russia. And you could argue in many ways that is working, because there's a formalized process now of rebated refined products and crude oil sales for Russia abroad. But of course, you can also criticize this now. No, they're getting around this, and there's STS ship transfers. But this is the overall, I think, the message that the US especially, but also the EU is wanting to send that, look, we're not trying to harm the entire world. We are hearing that not everyone considers this a global conflict. But what we need to do is reduce the revenue for Moscow so that it doesn't have as much money to finance its war in Europe and in Ukraine on the ground. This is, I think, the main message, what they're trying to balance back and forth. And this will also be reflected on how they clamp down on sanctions busting. They won't target entire countries. They might try and target really brazen attempts to at this, outside, literally inside of the Spanish coast or something like that. But otherwise, I think there's a process in place now that so far satisfies the US and its Western allies in this process. But of course, as I say, we don't see a resolution to this conflict anytime soon. So things might change. If you keep in mind at the start of this conflict, nobody expected the West to implement oil sanctions on this scale. So it's worth keeping an eye on. I'd say, unless Pamela or David, you want to add something? We do have a fair few questions here, so we can move to those if you like.
Yes, if I may try to start, let me go back to the slide here where we see the Russian diesel exports. So quite a lot of questions have come in, whether Russia will manage to find new markets. And also basically one question was also, why did they already start to export more to these North African markets and some other players? Now, for the latter question, you can see here, they really pushed diesel exports over the last couple of months. It's partly a seasonal thing, as Pam pointed out, but it's going beyond that, basically. Yeah, so I raised the money aspect of this. Yeah, the income Russia is currently making from oil and gas is very disappointing from their point of view with the low price environment, relative low price environment. So diesel is a key product to make a difference there. So that's why, you know, they tried to sell as much as they could, both to Europeans and to non-Europeans. Based on a lot of things we have all, I think it's likely that, yes, they will find markets. Yeah, it may require ship-to-ship transfers. It may require unloading and reloading it in storage terminals, especially initially. But there's so many countries out there that need diesel. There's so many countries that are under certain financial strains. Sri Lanka has bought Russian crude last year. Pakistan is currently in talks with Russia. They are in a very strained financial environment, but there are also many other players out there that are keen to get any dollar discount per barrel they can get. So yes, we do think that they will find markets. There will be a little bit of a delay, a little bit of hiccup period in between, but ultimately players will be found. Pamela, perhaps one question for you. There are a couple of questions about Chinese diesel exports to Europe. Is this something you would shed some light on, whether you think that will continue down the line?
We think that so China had a big push late last year for diesel exports, and the main reason for that was because they received a large batch of product quotas, export quotas, and so they tried to capture that diesel margin. Domestic demand was very low. I think, David, you mentioned before, China refineries really run to meet domestic demand. Domestic demand low. They were still in lockdown late last year. So there was a big push on diesel exports. Now that product quota, I believe, was carried over to 2023, and as an encouragement to increase refinery runs in China, but that's kind of been a bit slow based on how the lockdown recovery goes. So we have seen continued exports out of China of diesel. They haven't been as high as what we saw late last year. A part of that is because of refinery runs really not ramping up quite so quickly. Part of that is a little bit of consumer demand, but consumer demand, I believe, is more on the gasoline side. But some of those barrels are staying within the region because of the demand in the region for those diesel barrels. So yes, we do expect to see Chinese barrels possibly coming this way, or possibly staying within east of Suez, which then would allow barrels, then that knock-on effect of barrels coming over to Europe, probably from Saudi and India.
I actually find that there's a good parallel here to what happened last year in LNGs. I find if you look at sort of ship tracking and where flows go, it's a good indicator on how tight and stupidly undersupplied some markets can be. So last year, when spot LNG prices went so high, you did actually see some Arctic Russian spot LNG cargoes make the Arctic tour to Northeast Asia. You put into China and then resold back to Europe, going via the Indian Ocean and back to the Suez Canal. That works when you have crazy high prices, and it tells you that the market was really badly undersupplied, because at that price, everything works. So far, what I've heard here is that's not something we expect in refined products, if I'm not mistaken. Also, like as you mentioned, Pamela, more like ripple effect, sort of that sort of pushes things back here and forth rather than crazy voyages that otherwise don't seem feasible.
That's right. That's right. And Chinese refineries typically it's not necessarily the norm to make on spec European diesel. They can do it, obviously, but it comes at a cost. So I think, in terms of economics, they'd probably rather make the diesel that can land within the region, shorter voyages, and not so many costs in the spec, the diesel spec.
Right.
Yeah, the main suppliers will be the Middle East and India. India, of course, has certain limitations in its refining capacity and the strong growing domestic demand. Just on the specs, one news I remember from recently, Kuwait is now producing winter spec diesel for the European market. So, of course, these players, they're looking at the European market and they're preparing the specs the way they need them. I saw one question also on the demand situation in Europe. Of course, the very high energy prices, factually and partly anticipated, have led to certain reductions in the industrial activity in Europe, and there can be a bit of a comeback, but I wouldn't see this as a comeback for diesel demand. If anything, it's a comeback for natural gas demand, and the backup use or the alternative use of diesel should have stopped by now. So it's rather a negative factor for diesel from the industrial side overall, I would say, or at least not a particularly positive one. The other thing we have to consider is that European diesel demand from the road transportation segment is in structural decline. It's in decline because the car industry moves away from oil-powered cars, but even within oil-powered engines, there is a clear shift towards gasoline cars again. So basically, there is a steady decline in diesel demand for road traffic that's coming in on the European market as well. So overall, as said earlier on, the diesel demand situation at this point of time doesn't look particularly healthy. But of course, it's also a particularly weak period from a seasonal point of view. We will move on the one hand into the driving season. Of course, that's more gasoline story than diesel, but to a certain extent diesel as well. Jet demand is a very important feature because jet demand is set to increase this year again from the Asian market. Basically, European and American markets have already seen quite some comeback over the course of last year. So the jet is basically starting to cannibalize again the diesel pool on the refining side. And then on the demand side, what is very important from here onwards is basically agricultural demand in spring that will relatively soon kick in and support the global picture. But overall, at this point of time, the refining industry should do particularly well. There was a little bit the question mark about US refining, which has been hit by outages and which goes into a very strong maintenance period right now. So there could be some shortages in the next couple of months, but the more of these new capacities coming into the market, the less likely it is that we will see significant product shortfalls this year. Are there any new questions you guys have seen in the meantime?
Will we email the slides?
Yes, we will.
There's a question on what's your view around economic recession. I can answer a little bit on that. So first of all, caveat, I'm not an economist, but we do have an economist team that sits next to me. And I do look at the industrial situation, particularly in Europe, quite a lot. There's a sort of a sense of cautious optimism here. So last year, especially the gas price spike hit Europe's energy-intensive industry really heavily, so the chemical industry really badly. And the industrial output of the energy-intensive industry has gone down by about 8 to 10% in Northwest Europe. So that's where the big hubs are, Germany, Netherlands, Belgium, and Northern France, similar in Northern Italy. That would suggest a recession. However, what's happened is that the overall industrial output is only marginally below 2021 levels. So that means that the less energy-intensive industry in Europe is clearly doing not greatly, but okay. And that probably means that we will have to wait and see what consumer spending does on whether there's a recession this year or not. When it comes to heavy industry, I talk to them a lot. They are also cautiously optimistic because they have invested heavily into efficiency gains. So they have improved insulation by thermal coating. They have invested into modernizing old units with new units, so the efficiency immediately improves. And that is efficiency. Once you've made those gains, you never get back. So that will mean that their energy consumption, especially with natural gas, probably by the end of this year, will be around 30% below pre-crisis levels. And that's the sort of stuff that never comes back. and that means that they actually think this year is going to be complicated and bad. There's still going to be a headache of high OPEX costs for fuel, but not as bad as last year. And there's a high CapEx need to ongoing investments into more efficiency and alternative fuels. But most of that, that means that this year will still be bad, but not catastrophic as last year seen. And come 2024 or maybe 2025, most industry actually for Europe sees a deflationary green energy dividend to come about, because they're now being forced to make investments that they didn't think about prior to the crisis. But still, we'll have to wait and see with this year whether there'll be a recession or not. I actually think so in terms of industrial orders, they're picking up again marginally. So it looks like flat to slightly negative. So that means most will depend on consumer spending. And there the jury's still out, I think, because we simply don't know how that's going to develop this year. But it's not as bad as it seemed last year. So cautious optimism, I'd say.
Yeah, so a lot of other questions coming in. Let me try. One point I wanted to make clear, a question that comes up relatively often is whether Europe would import Russian diesel that has been exported first to other places. And I think that is something that will not happen, yeah, because there is simply no need for it. What may very well happen is that certain countries like perhaps Turkey, like India, like perhaps the one or other Middle Eastern country may import Russian diesel, use that Russian diesel to meet domestic consumption and export some additional diesel that is freed up therefore for the export market. But I think all players will be very cautious to make sure that the diesel molecules get not mixed up, simply because there is no need to do it. Yeah, there is enough economic incentive to keep those barrels separated.
There's one question that was directly answered, addressed at me. I was about to type it, but I can answer it. So curious how you think about the evolution of the EU-US relationship over the past year. Seems to me that US fossil energy exports have been critical to EU security of supply, but that doesn't seem to be appreciated. So that is absolutely correct. The biggest increase in supply of especially natural gas to Europe, what came from the United States. In fact, France became the biggest buyer of US LNG globally last year, and most of that gas actually didn't end up in France. It went on to Germany. So there's no doubt about this. Without Russian natural gas, but also oil supply, but in particular LNG, Europe wouldn't have gotten through this winter, and it wouldn't get through next winter either. And it might not reflect fully in the media, but in political circles, I know it is reflected highly. And we did see actually at the start of this crisis, so in March last year, the US-EU LNG partnership and methane partnership were forged. And overall, at Eurasia Group, it is our firm view that the US-EU relations haven't been this good in at least a decade. That's, the US has led through this crisis. Again, I mean, the brutal reality is Ukraine would be toast without the US, and the Europeans wouldn't have done much. But they did lead the EU out into a stronger action. They have helped economically. Of course, US energy companies also made a fortune out of this, but so be it, so have the Norwegians. So I do think this has been appreciated, and there will be more US oil and especially natural gas going to Europe than we thought was physically possible a year ago.
Yeah, I want to say many thanks to everybody for all those questions. It's really great to see so much engagement. I may do a very quick marketing pitch. Vortexa clients can join a market briefing every single week, actually 2 of them for 15 minutes, where you get the latest updates on all these flows, all this type of charts have been presented in these market briefings already. I do want to answer 2 quick questions. So one I think is important. At this point of time, we see no indication that Russia will have to cut back its exports, neither crude nor refined products, and that includes also naphtha and residual fuels. Naphtha and the residual fuels have already found a lot of homes in the east of Suez markets. They will continue to do so. Vacuum gas oil exports have already been rerouted to places like India, for example. So at this point of time, it looks very likely that Russia will be able to continue its production and its exports of both crude oil and refined products down the line. And yeah, as said, there will be buyers for those products. Yeah.
Last words. for me also, if you have any follow-up questions that we didn't answer, email me, glorstein@eurasiagroup.net, so surname @eurasiagroup.net. I'm happy to engage with anybody. Amazing, as a political risk analyst, we're actually saying no need to panic. Isn't that amazing?
Great. Many thanks to everybody for joining us, and looking forward to see you at different events.
Thanks.
Thank you.